Hello, DR, and happy Friday.
Hey, it's great to be with you on a Friday, Richard, of a very full week and a very wet one here in the East Coast.
It's been very wet here too, so like biblically wet, I would say.
Yeah, I know you've been traipsing around the mountains. Story for another day, but lots of things going on in weather patterns, and lots of things going on to talk about in the markets that are moving markets, especially in some non-traditional assets.
Well, let's get into it because I'm sure people would rather hear about markets than our personal lives.
Well, probably so, even though you are always intriguing, Richard. So let's jump in.
All
Let's
right.
talk about one of those non-traditional assets. Let's talk about Bitcoin that's on the screen now. This is Bitcoin in terms of US dollars. And if we look over here on the far right-hand side, everybody can see that we had this huge run up this week, the last couple of weeks, but especially a couple of outsized days today, in the last couple of days. And Richard, I know from people that are looking at this, that have seen your work in 7 Principles of Successful Investing course and other things, that you've been a proponent of Bitcoin for a long time. And I was really interested on your take of how this thing has just exploded the last few days.
Well, it has been an interesting move. I had a really great signal on this from, we did that webinar with the Cycles Foundation last week and introduced the Cycles app. And I was watching a 2-hour chart of Bitcoin, and it came down and touched the zone that we had been teaching people about in that course, and then rocketed up out of there. So I wasn't expecting it to be this big of a move. I've been saying for a while now that Bitcoin looks pretty bullish. I'm not entirely comfortable with the reasons that Bitcoin is rocketing up right now, because I think that it's mostly about a lot of the other altcoins getting killed because the SEC is cracking down, and also that institutional players are getting involved, right? So BlackRock came out and said that they're going to put forward an ETF proposal, and maybe they'll be the ones that get the first ETF approved. Meanwhile, the SEC is cracking down, and letting all the exchanges know that they're going to be in trouble if they don't follow the SEC's guidelines. So, is it really exciting that Bitcoin is becoming more institutional? I'm not that excited about it, I'm happy that Bitcoin's going up because I own Bitcoin, but it just seems like, the worst part of Bitcoin to me and of the crypto space is that it's only been a trading game, and that's what bothers me about it, that Wall Street is just looking at it as another asset which can be traded and create flow. And the institutions, need to elbow their way in here to control and own that action. Basically.
Yeah, to get a piece of that pie. I think one of the really interesting things that came to me this week, Richard, is that while SEC's cracking down on a lot of the altcoins, anything that's not Bitcoin, is that the flow didn't run out of crypto into bonds or into equities. It ran into the big Mac Daddy of all crypto. It enriched Bitcoin as an asset, single asset. And I thought that was affirming for people in the general crypto space. What's your take on that?
Tell me a little bit more about that. Give me a
So
little bit more background
if assets are going out of the low cost, the low value, the more volatile bottom rung coins
of the crypto spaces, so the altcoins, etc.
The altcoins, so money's running out of altcoins because they are going to be there. Looks like they're going to be regulated. that money didn't run into the equities markets
Okay.
in mass. It
Yeah.
ran a lot of it ran into Bitcoin itself,
Hmm.
stayed inside the crypto corral, if you will. And I think that's a positive for crypto as an asset, and of course Bitcoin as the big dog in that asset class.
Yeah. Do you know what happened with Ethereum this week? I wasn't really
Ethereum
paying
had
close
a very
attention.
strong week. I actually
Yeah.
had a chart up, and we could take a quick look at a chart that
So yeah.
Ethereum actually, the correlation of Ethereum and Bitcoin was strong. Typically, if it was just a move in crypto or a risk on move, Ethereum would want to take off. And I think what we saw instead was that actually Bitcoin had a stronger week, but not a ton stronger.
Well, I
Let's
think
take
that basically Bitcoin and Ethereum are the um, cryptos that the SEC has said these aren't securities, and everybody else is having a tough time proving that they're not securities. So um, I'm not surprised. And look, I've been a critic of a lot of the scams that have gone on around altcoins and NFTs, etc. At the same time, seeing Bitcoin and Ethereum basically get embraced by institutions. Look, on the whole, it's positive. Uh, I hope that it's more than just institutions getting control of the flow.
Yeah, I'll just drag a chart over real quick here so we can see this is Ethereum.
Yep.
Same chart on the same
Yep.
charting package we
Looks
just
very
looked at.
similar.
Yeah, very much, very similar, and not a lot of difference between those two for the exact reason that you just pointed out.
Yeah.
Well, let's look at a Bitcoin in a little different way, if you would, Richard. In your way, and I say your way because I think you're one of the pioneers of saying, let's not concentrate on price, be aware of it, but let's look at really what the day to day movement is. What is the real volatility underlying an instrument? And this histogram view, I think, is going to be one that is going to only grow in terms of how people look at individual assets and asset classes. So tell us a little bit about what we're looking at here in the histogram of Bitcoin, and I'll mark it up if it's of use to everybody watching out there.
So if you look along the bottom here, what this is showing us is what percentage did Bitcoin go up or down on a given day, right? So we don't have the days of the week marked in here, but Bitcoin had some pretty big moves this week. They were all positive. I suspect they were in the 3, 4, and 5% buckets. That last bucket, 5%, is 5 and above. So
Right?
I'm pretty sure Bitcoin had a 6 or 7% move,
It
daily
did
move
have
at
one
least
this week.
once.
Yep.
And so what this shows us is basically, how often are the moves 1% or minus 1%? And how often are they, out at the extremes, 5%, plus or minus 5% or more? So this shows us just at a glance kind of how volatile it is and how normal it is or abnormal it is. So Bitcoin's got some fat tails, as we say. You can expect it regularly to have moves of 5% or more, either up or down. And we certainly saw that this week. So yes, these moves were big, but they were par for the course for Bitcoin. So I find it very interesting to look at these histograms. It tells me just at a glance whether I should expect an asset to be volatile or more normal. So yeah, I
And
think
I
it's
think
great to look at these.
Yeah, and I think we'll be looking at them more often, especially when we talk about asset classes, even a sector or a single stock or other things that people are going to find them as useful as you have in developing the apps that we're using to look at assets as a volatility instrument, not just as a price moving around on a chart.
Yeah, and one of the things that interests me about this so much, DR, is how much the media loves moves of 5% or more.
Hmm.
I guarantee you, if we look at what assets made the headlines on any given week, they're all going to be assets who were moving, in their out at their tails.
Hit the tail.
So,
Absolutely.
you know, why do we hear so much about Bitcoin this week? Because it was up 5% or more, And meanwhile, that's to be expected. So is all this noise around Bitcoin this week really significant? No. It's really the media grabbing onto attention, getting moves, and then using that, interest to capture our attention and then have us focus on what they want to focus on so that they can ultimately modify our behavior. So,
Well, it's yeah. And one of the things that we wanted to talk about very briefly this week was that that role of the media in getting people to act, to move, to do anything in the markets is being amplified over the past years. The media's role is not just reporting the news; it's to opine, it's to have an opinion about the news, and we saw that this week, Richard, in that there was hardly any economic news the first half of the week. The only big news out was this one that housing starts were up 20% month over month from April to May. As you see that green bar out there to the right. And that was the only thing there was to talk about. So they talked a lot about it. And this is just whether new permits or new starts, they start digging a hole in the ground somewhere, are going on. And you can see we've had a big down slide in this for a long time. The housing starts in general, they've been going down, and then we get a pop. I think that's a good thing for everyone in the construction industry and people in the real estate industry. But other than that, I don't know that it's a big economic indicator to have a 1 month outlier that pops. It just gives people something to talk about.
Certainly not worth 3 days of media coverage. Admittedly,
Well
it did catch everybody by surprise. It does kind of go against the narrative that real estate is in trouble. And so it is interesting in that regard, but definitely not worth 3 days of media coverage, which is what we saw, during a quiet week. And I agree, totally speaks to the media's addiction to something to talk about.
And speaking of things that didn't get enough coverage, the media covering this, but here's one that you and I talked about kind of real time while it was happening. And I'll pull up a chart here of this is from Bloomberg data of the UK's inflation report that came out this week. This is showing the dark blue line is showing core inflation in the UK, and how while the US, we know the white line here has been dropping, as has Germany's. The UK in the past 3 months has been skyrocketing to where core inflation year over year was up 7.1% in May. Got a lot of people concerned, and then the Bank of England did something about it.
Right. This is definitely going in the wrong way, and is a bucket of cold water on the narrative that inflation is coming under control. Right. Look, there's a lot of debate on this issue, a lot of totally fair debate, good debate. The UK could just be an outlier because of things unique to the UK. Personally, I think the UK is not an outlier. I think that inflation is more entrenched than not the Federal Reserve. Jerome Powell was out this week talking about inflation and saying they expect to raise rates a couple of more times, right? So I kind of think Powell's right. And I know the market thinks that he's not right, but this to me points to inflation entrenched. I don't think the UK is really a big outlier here. I would not be surprised to see inflation pick back up over the next few months.
I think the interesting point from the market reaction this week that caught me, Richard, was that Thursday morning, right when we were talking about this, you were sending me some articles and some of the
Mm-hmm.
folks you read, and I was zapping you some data. And the thing that happened was that one of the people opined that we might get a 50 basis point raise from the Bank of England. And I typed into you, wow, I think the market will drop like a rock if that happens. And it did happen. The Bank of England did come out with a surprise 50 basis point increase on Thursday morning before the U.S. markets opened. And the U.S. markets went, ho hum, we're going to keep going up, fear of missing out. And I think that was a little bit telling about the market psychology right at this point in time.
Mm-hmm. Look, when you go up on bad news, that's a bullish sign.
Yeah.
So it's a tough market.
It's a tough market. Sometimes good news is good news. Sometimes good news is bad news, depending on how people think the money supply might be controlled. And it's a tough market to read. I will agree with you completely there.
But this is not to be ignored, and the fact that a major central bank, really the founding central bank, raised 50 basis points when inflation's supposed to be coming down everywhere, right? We're supposed to be in a deflationary environment now. Didn't happen, and they're not the only ones. So definitely something to be paying attention to.
Yeah, I mentioned earlier in the taping here that your seven principles course which has just such great background and support, and I love everything that you've done there, and we're going to be talking more about that. But
Thank you.
one of the luminaries of Wall Street came out and said some things that were pretty interesting, that were right in support of all of the things that you bang the table about in building your own perfect portfolio for each individual investor. I want to pull up a slide that came from a podcast this week called Odd Lots. So there it is. It's a well done, good production value podcast. But this one was live. It was kind of cool, and the guy was Steve Eisman, who's the managing director at Neuberger Berman. I know you listened to it first and sent me over the recording. I think it's some really interesting stuff. Why don't you walk us through what he said?
Well, so Steve Eisman was one of the characters in the movie The Big Short was based on Steve Eisman, right? Because he shorted a lot of the CDOs in the run up to the financial crisis and made a lot of money. And what fascinated me was he said to the hosts of Odd Lots that risk-adjusted returns are coming back in vogue, that people will want to know how much risk they're taking and how much return they're getting. And what fascinated me was that the hosts had to ask him what risk-adjusted returns were, right? And he said, well, it's when you measure your returns in terms of the units of risk that you took, and they were like, well, doesn't everybody do that? And
one of the hosts said, doesn't everybody already do that? And he said,
no.
Oh, no, which was your second point.
Right, which is that's also that, well, what he said was that you've been getting paid to just take as much risk as you can, and everybody was just like, get me 50% in tech, and that those days are over, right? And I think he is spot on. You can't just be 50% in tech these days. Money is no longer free. Yes, tech is enjoying a little hype rally right now because of AI, but I'm telling you, those days are over. When you can get 4.5%, 5% in a money market fund, when you can get good fixed rate investments at this point, you've got to be combining those fixed rate opportunities with equities and other asset classes, but you've got to be thinking in terms of your whole portfolio. And then the last thing he said that was really cool was that personalized risk tolerance is coming back in vogue, that people are different. Yes, there are guidelines, we're in different generations, we're in different cohorts, but ultimately everybody has their own unique risk tolerance. So those are definitely themes that are near and dear to me. So it was great to hear, somebody like Steve Eisman say those are coming back, and that they really haven't been in vogue. People have been ignoring them for 10 years, which was, I think, also spot on. So yeah, that was great. Fantastic stuff.
Yeah, Richard, and what you said at the beginning of this section about risk adjusted returns and not chasing after those big moves like you could when money was almost free, when we had interest rates that were around zero. That's not the case anymore, and it's not going to be the case for a long time. So I think that's a really prudent way to think about investing, and it's never gone out of style, really. That risk-adjusted returns are going to be something we talk about a lot here in Market Moves and a lot in the Dr. Richard Smith universe as we move forward.
Yep. Howard Marks famously called it a sea change. And I've quoted that a few times. I absolutely think that we are in a sea change. Another thing that Steve Eisman said was that, we don't really think about our paradigms. We just kind of live in our paradigms. And there are big paradigm shifts going on in the markets right now. The biggest one, of course, is that rates are no longer, zero or negative, and they're not going back. So that is huge. People have been investing in a declining rates market for 40 years, at least 2 or 3 generations. And we don't know what it means to be investing in a market of rising rates. But that is what we're faced with. And I'm convinced that that's what we're going to be faced with for a long time to come. So get your head out of your paradigm.
Well, I think it's that thought of looking from outside your model of the world, your paradigm, your model of how things work. Don't just live in it. Don't just be part of it, but step back sometimes and look at yourself in that paradigm and how you're living it. I think that point of view is something that is really, really valuable for everyone, and is another of the themes we're going to be talking about in the near future.
Sounds great. Good stuff, DR. Thanks for putting it together and bringing it to everybody's attention. Really appreciate it.
All right. Well, have a great weekend. And everybody out there, we'll see you next week on Market Moves.
You too. Bye.